Welcome to Chapter 2. This is financial accounting. In this chapter, we're going to be covering recording business transactions. So we'll move on. Let's go ahead. This section right now, we're going to be doing section 2.1. We're going to explain accounts as they relate to the accounting equation, describe common accounts. I will be doing the other sections as we move forward 2.2, 2.3, 2.4, 2.5, and 2.6, and have them as their own separate sections. So if you'd like to watch the videos for that one, that would be fine. This way you can go into whichever area you would like to view. If you like to view all the accounts, that's fine. There's also a podcast out of these that you can listen to, hopefully help you as well. Let's go ahead and dive into 2.1. So, section 2.1, we're going to explain accounts as they relate to the accounting equation, describe common accounts. So when we talk about an account, what is an account? We have to go back to our accounting equation. What do we have in the accounting equation? We have assets equals liability plus equity. So what we're talking about in assets, right? We're going to discuss each one of these further as we've done in the past. Assets are things that are going to bring more revenues in the future, right? Things that are going to cause us to earn more revenues, to earn more money in the future. So we either things that like cash, buildings, equipment. We'll talk about these accounts here in a minute, but all these things help us make more money, make more revenues, right? And we either owe or own these things, right? So liabilities are things that we owe, things that we have on loan, things that we are making payments towards, things like buildings, things like loans, things such as cars, anything that we have on credit, right? It can even be supplies or materials. Equity are things that we own, right? So if we've put in money into the account, into the business, if we've taken in shareholder money, all these things that are taken in, the shareholders, they own that money, right? They own the whatever is the business owns, that is equity, right? So we either own our assets or we owe them. The accounting equation contains three categories: assets, liability, and equity. Each part contains accounts, right? And what is an account? An account is a detailed record of all the increases and decreases that have occurred in an account during a specific period. So an account is just a way to specifically name and separate things into a more organized viewpoint. So all assets break down into different accounts so we can organize them and know and track their balances. Same thing with liabilities and equity. So all these different sections have different things that make up each section, and those things are labeled into accounts. And what can be an account? Well, with assets, cash is an account. So business's money includes bank balances, bills, coins, and checks. When we talk about cash, we're talking about anything liquid, anything that can be converted right then and there. So cash cannot be things like stocks and things like that. That's not cash. It has to be something that we can use to purchase items and to buy things, and it's liquid. It has to be have liquidity. Accounts receivable, these are like IOUs, right? Things that the company has performed, has done jobs, has sold material, has sold products, and whoever we've sold them to or we've performed the service for, they owe us for that. And so that is an account receivable. That's something we're going to receive in the future. Notes receivable is the same as an accounts receivable, but most of the time it's over for a longer period. And because it's over a longer period, it is a written promise. This is more like a car loan, something like somebody has a long period extension with us that they're going to pay us over a long period of time. Then we'll usually do a notes receivable. That way we have it in writing that we're going to be receiving these payments. A prepaid expense. What is a prepaid expense? A prepaid expense is something that we've already paid for to receive services in the future. Think about prepaid rent. If we go and we rent a building for our company or for our corporation and we're going to rent, we're doing a monthly basis. Say we don't want to worry about making those monthly payments. We go ahead and we pay upfront a year in advance. That's a prepaid expense. Every month, the owner of that building owes us rent. They have to make sure that we have a place to stay, that we have that building is for our use. And so every month they have to make sure they provide that for us. And as we go, we are using up that prepaid rent, and that prepaid rent becomes a cost later, right? As we use it up. But until we do, it is an asset that we are going to is going to provide us a benefit in the future. Land, right? The cost of land a business uses in operation. This is providing us a service throughout the future. Also, a building that's in this asset provides us a service to make money in the future. This also includes equipment, furniture, and fixtures. All these things we use to provide to create and earn revenues in the future so the business can survive and produce. Liabilities, these are things that we owe, right? So accounts payable, this is a short-term loan that we're getting from some other company or for another person and that we are going to pay, right? The debt in the future, usually not, it's not a written promise. That's because it's usually a short-term 30-day loan or 30. We have a certain short period of time to pay this account off, right? No payables are usually a long period of time, and this is usually a written promise made by the business to pay a debt. Usually when we take out a loan or we take out a mortgage or we do a long-term contract, this is going to be a note payable, something that is written. Accrued liability. So what is accrued liability? This is something that when we receive the prepaid payments, right? So let's say we are renting a building to someone, then what happens is if they pay us for the year, we have an accrued liability. We owe this person a year of that building to be able to be in that building for a year. So we haven't earned the money yet, right? Until each month has been used and that whole year has been spent, we owe that person the building, right? And so that money is a liability to us because if we don't provide it, then that money we have to give back. Unearned revenue is when somebody pays us for our services in the future and we have yet to perform the duty, right? So let's say that I'm booking one of the examples I like to use is I like to purchase books. I like to read a lot. And when my favorite author comes out with a new book and they've already posted when the release date is, I like to go ahead and pre-order that book, and I'll pay for it in advance. That is unearned revenue for the author, right? They haven't even finished the book. They have the due date. They know when it's going to be released, and they've already started receiving the funds, but yet they have yet to provide me with the book, right? So they are when some we have we've already received payment for something we haven't completed or something we haven't provided, then we have unearned revenue, and that is a liability, right? If we do not provide that service or if say they don't send me the book, then I can ask for a refund, right? So that's unearned revenue. That revenue has not yet been earned. So it's not revenue, right? It is a liability. Equity, common stock. This represents the net contributions of stockholders in the business, increase equity. So as we buy pieces of the company, we buy stock. The common stock is equity, right? So the common stock shows us how much of the company is owned, how much is in the company. Dividends, this is lowering, right? Equity lowers our dividends, lower our common stock. It usually lowers our retained earnings. So usually common stock is divided by our retained earnings divided by the shares of common stock to show how much earnings per share we've made. And we lower that, or we lower how much money we put into the company or split amongst our shareholders when we issue dividends. Dividends are when we issue payments to the stockholders by sharing the profits. So instead of having the stock go up in price and having retained earnings and raises up the value of the company, we decide we are going to share the profits directly with the common stockholders and send them a piece of the pie, right? So we actually send them a payment based on how many shares they own. That's how much earnings they will receive from the company. So that's dividend. Revenues, this is when we performed a service or sold a product or something like that, and we are due payment. That's when we take in that payment, that is revenues. Now, revenues are not profit because you have to take out expenses to get profit, right? So expenses are things that we pay for on a daily basis to keep the business afloat. Anything that you have to pay for to keep the business going, that is an expense. So expenses are things that take away from our profits. Revenues are the things that increase our profits. Now, we break down everything into a chart of accounts. A chart of accounts is an easier way to view and to organize all of our accounts. So, what we do is we break it up into the different sections. We have assets, liabilities, equity, revenues, and expenses. And we use these different sections to separate everything off and to keep them in order. So, and what we do, not only do we keep them in their own section, but we number them, right? So the numbering system, usually we have 100, 200, 300, 400, and 500. And then based on what type of account it is, you fall within those sections. And then based on which account it is, that gives its own specific number within its realm. So assets are usually 100, liabilities are 200, equities 300, revenues are 400, and expenses are 500. Now, if you do have a large corporation and such, you can have thousands, but it's usually one, two, three, four, five, right? So in those areas, you can have 1,000, 2,000, 3,000. But when we're talking about in this book, we're talking the hundreds, right? One, two, three. So that lets you have different accounts with different numbering system and allows you to see what by knowing the number of the account, we know what type of account it is and where it lands within that type. A ledger is where we take the account separately and we record all the transactions that would happen within that account, right? So the ledger allows us to see what happened with each account, if they increased or decreased, and what the current balance is. The ledger allows me to see how much cash do we have currently? How much account receivables do we have? Are they high? Are they low? Ledgers let me view that as I record transactions and update the ledger. This allows me to see where every account stands. So, data analytics and accounting, the number of accounts in the company's chart of accounts depends on its size, right? Like I said, you can have the hundreds of thousands. Walmart can probably have millions if it wanted to, right? You have all these different accounts. Then you have different accounts for different transactions, all create different accounts. And you can have as many as you can think of, especially if there's things on complexity of the transactions they're doing, the number of locations. Each location can have a sub account, so there can be lots of accounts out there. The chart of accounts can be used to process transactions and business activities, right? So we use that to see where transactions occur, analyze accounting data, compare prior period amounts to current year, and then identify errors, tracking changes in accounts. So by looking at our chart of accounts and seeing how our ledgers and we look at how they change over time, we can see how things go up, how things go down, where we stand, and where we currently are with certain accounts, right? You always easy one to always remember is cash, just seeing where we stand as far as how much cash we have on hand, how much cash accounts receivable. These kinds of things will let us know, viewing through a chart of accounts, where we're at. Okay, so we're going to go ahead and pause here, and I will pick up on section 2.2 in the next video. Okay, let's continue with chapter 2. This is section 2.2. We're going to define debits, credits, and normal account balances using double entry accounting and T accounts. Now, there are a few things that we need to understand when we look at these things, and I'm going to try to walk you into it. I don't want you to jump the gun too fast. Now, you will probably, a lot of you guys are very intelligent. You're probably going to move on ahead and you're going to understand things pretty quickly. But for me, it took me a while to understand it myself. So I want to go ahead and get a couple of things across to you before I have you go ahead and jump out and start learning how things increase and decrease. I want you to first understand what debit and credit first mean. So, what is a double entry accounting? So, what do we are talking about on double entry? Every account transaction has two sides, right? You have, if you're buying something, somebody's selling something. If you're selling something, somebody's buying something, right? So everything has two sides to it. So we have to account for both sides of this equation. Okay, so anytime we make any kind of transaction, we record any kind of transaction, there has to be at least two sides. There has to be two accounts that we are dealing with, right? Accounting uses double entry system to record the dual effects of each transaction. For example, office supplies are purchased for cash, require an increase in office supplies and a decrease in cash. Think about every cause has an effect, right? Think about it as a scale. We have to even out the scales, right? So if we take from one side, we need to take from the other, and they need to even back out. So never will you have an accounting transaction with one account where you put down one side of it, right? You may have multiple accounts. You may have three, four accounts that happen with one transaction, maybe even more. But you will never have a transaction that has one account only. There has to be at least two accounts being affected here, or there is no transaction. So everything that we do, every time we enter a journal entry or enter a transaction, we are always going to have two accounts be involved. There's going to be two sides to every transaction. The T account. The shortened form of the ledger is called a T account, right? So this is having an account that allows you to see in a T, and the account has a left and right side. Our left side is called debit, our right side is called credit. This you're going to need to remember. Debits are always on the left, credits are always on the right. Because we use this when also doing journal entries, the T account is not the only place where you will see a debit and credit. Debits on the left, credits are on the right. That's all you need to remember right now. Debits and credits. Later, in the next slide, we're going to talk about how debits and credits affect each account. But right now, I just want you to think debit on the left, credit on the right. Debit on the left, credit on the right. Debits are always on the left, credits are always on the right. You're always going to try to do your debit when you read left to right. You're always going to do your left side first, your debits, and then your credits. Okay. When we're looking at this account, this T account, the way it stands, debits on the left, credits on the right. Anytime we have a transaction that involves a debit, we'll put it in. Anytime times we have a transaction involving the credit, it'll be on the right, and we'll have the name of the account. So this T account allows us to see each transaction that's happened that's involved with this account, and it also allows us to go ahead and balance out those transactions as they are occurring. Increases and decreases in account. Now, this is where it can get kind of confusing. Depending on what type of account we are talking about, debit can mean increase or it can mean decrease, right? And an asset debits increase the account. Say if we have an increase in cash, that is going to be a debit. If we have a decrease in liabilities, if we paid off some kind of accounts payable, then that is going to be a debit, right? Assets decrease with credit. So as assets go down, they will be entering credits. And liabilities, they go up with credits. Now, equity, we're going to go ahead and say equity goes down with debit and credit and goes up with credit. But equity, as we know, breaks out into many more accounts. And those accounts will have each, as we go into revenues, expenses, owner's equity, and our common shareholder stockholders' equity and dividends, those are going to be different. They're going to increase and decrease differently depending on the account as well. So we'll talk about those as well. So let's look and see. So we see that in the asset realm, increases are a debit. To increase cash account, a business would record a debit to the cash. On the left side, debit. If we're increasing cash, it's going to be on the left side. It's going to be a debit. If we're decreasing cash, it's going to be on the right side. It's going to be a credit, right? So let's say that we put $30,000, we bought $30,000 in shares, debit, cash will go up 30,000, we'll debit cash, and some common stockholders shares will go up on the right and the increase with credit. Cash, right? Let's say we bought a new vehicle, right? Or we purchased something, right? So let's say we bought a new car. That's also an asset, right? Cash, let's say we pay cash, cash goes down with the credit. That's $20,000 credit. And car or vehicle, that account would go up with the debit, right? So we'd have two sides. But and one asset is going up, that's a debit. One asset is going down, that's a credit. Now, let's expand the rules of debit and credit. The accounting equation expanded and include the rules of debits and credits for elements of equity. So we know that equity breaks down into common stock minus dividends plus revenues minus expenses. Each one of those, common stock, dividends, revenues, and expenses, each have their own way of debit increasing or decreasing and credit increasing or decreasing. So let's break this down further. We have assets increase with the debit, decrease with the credit, liabilities, decrease with the debit, increase with the credit, and common stock decreases with the debit, increases with the credit, dividends decrease or increase with the debit, decrease with the credit, revenues decrease with or increase with the debit, or decrease with the debit, increase with the credit, expenses increase with the debit, decrease with the credit. So those are all of our separated accounts and how they increase and decrease with debits and credits. Usually, the normal balance, all accounts are summarized on one side of the T account called a normal balance. Usually, assets will have a normal balance of debit, right? Or that's what their normal balance is. So usually you'll have a balance in assets. Usually, if they have any worth, they're going to be a normal balance of debit. Normal balance appears in the increased side of the account. So usually where the account increases, like liabilities increase with credit, that's where its normal balance is going to be. Common stock increases with credit, that's its normal balance. Dividends, the increase with a debit, that's their normal balance. Revenues increase with the credit, that's its normal balance. Expenses increase with the debit, that's where its normal balance is, right? Liabilities and equity increase with the credit, so the normal balance is a credit. So think about it. Usually you will see when you look at the balances on T accounts or you look at the balances on a, we're going to talk about this further along our balance. When we look at our statements, right? We're going to look at see where each account is balanced, where how much is in each account. Or when we look at our ledger and our T accounts, when we look at it, usually they're going to the ending balance is going to be on the normal balance side. So rules of debits and credits and normal balances for each type. Assets, right? Increases, decreases. So this would be a great slide to print off if you want something to look at in the future when you're doing exams or you're doing any kind of work. This is a great sheet to look at to help you to memorize this. If it's assets, how they increase, expenses increase and decrease, and what their normal balance is. An easy way to remember the rule of debits and credits is to memorize this helpful sentence. I didn't memorize it, but maybe this helps you. All elephants do love rowdy children. The first three words in the sentence will help you remember that assets, expenses, and dividends all have normal debit balances. The last three words in the sentence will remind you that liabilities, revenues, and common stock all have normal credit balance. Okay, so assets and equity, or assets and expenses have normal debit balances, and dividends have debit, and then what is it? Liabilities, revenues, and common stock all have credit balance. So this is a T account, and this is after a few transactions. So what happens in a T account? All your this is a cash, this is an asset account. So all the increases on the left were all the transactions that increased the account are on the left. So we had transactions that 30,000 and 5,500, and all the transactions that decreased the account are on the right as a credit, 20,000 and 3,200. How do we balance this account? What we do is we take the left side and the right side, total them up, right? So on the left side, we got 35,500 total. And the right side, we have 23,200 total. And we take those two balances and take the higher amount minus the lower amount. And then we put the balance on the higher amount. And so we have 12,300 debit balance, which is on the left side because it's a higher account number. And usually you're always going to have a debit balance when it comes to cash unless you're out of money, right? So we'll talk about that later on. Let's pause there, and we're going to go into section 2.3, recording transactions in journals and post-journal entries in the next section. We'll see you then. All right, let's get into section 2.3. This is the meat and potatoes of the whole chapter. So this is where we're going to see different examples and where we post different transactions and how we post them. Hopefully you can follow along and use these examples in your homework and in your quizzes. And hopefully you can look at this, and if you have any questions, you can refer to this, and you can always refer back to me. So, learning chapter 2.3, record transactions in a journal and post journal entries to a ledger. So, the first thing we're going to do is learn how to post to a journal. Accountants use source documents to provide evidence and data for recording transactions. What is a source document? This is where we trace it back to what actually happened, right? A receipt, an invoice, anything that shows what actually happened to create this transaction, right? When if I won't buy some, if I go and buy something, I have to have a receipt for it. Or if I want it to be recorded, I need to have some kind of check or something that refers to what happened and how it happened. The documents help businesses determine how to record a transaction. This is why source documents are always important. To trace things back to the source always helps accountants understand what is going on. Usually, when we see a mistake or we have questions about how things are formatted or where transactions are located, we usually go back to the source document to make sure that it was entered correctly or it was put in the right account. So the flow of accounting data, first we have the transaction occurs, there was a purchase, there was revenue made, there was some kind of service provided, and then we have a source document, right? We for deposit only, we here there's a bank deposit, they deposit the money into the bank, they got a deposit slip, and then transactions are analyzed. This is where the transaction is given. The deposit slip is then given to the accountant. They'll overlook it and they say, okay, we had this deposit in. What was it? Why did we make this deposit? It's usually listed on the source document. And then we go and we journalize and post that transactions. Other source documents used include purchase invoices, bank checks, sales invoices. These are all things that can trace a transactions to where it started, right? So, how do we journalize, right? The journalizing and posting process has 5 steps. The first step is to identify the accounts and the account type, asset, liability, or equity. What are we dealing with, right? When we look at the transaction, are we dealing with assets? Are we dealing with liabilities? Are we taking out a loan? Are we purchasing equipment? Or is this equity? Is someone purchasing stock? This is what we first have to identify. What are the accounts that we're dealing with? Second thing is decide whether each account increases or decreases and apply the rules to debits and credits. So, is the cash increasing? Is it decreasing? Or is accounts payable increasing or decreasing? We got to figure out what these accounts are. And then if they're decreasing or increasing, and then go back to our credits and debits and see what is the rule of this. We're going to record a transaction in the journal. So once we know if it's increasing or decreasing, it's credit or debit, we post it in the journal, and then we post this journal entry to the ledger. So we do one section, one posting to the journal, and record it in the transaction in the journal. Then we post that to the ledger, carry over this transaction to the ledger. Determine whether the account equation is in balance. Step 5 is to determine, did we do everything correctly? Did we do both ends, right? Did we have a double entry? This will help us understand if we are correct with imbalance or not. So transaction number 1, let's look at, we're going to have quite a bit of transactions, and let's see, we're going to go through the steps of how to apply it and post, how to put this, how to journalize these transactions and then post them to the ledger. First thing, on November 1st, the e-learning company received $30,000 cash from Sheena Bright, and business issued common stock to her. So she purchased common stock, right? So asset, cash was a debit, increases, right? Asset, cash goes up. So we have a $30,000 debit, and then common stock also went up, and that was a $30,000 credit for common stock, which is under equity account. We're going to go ahead and we're going to post this transaction. Now, this is how we post journal entries. This is a journal entry, right? First thing we're going to look at is, this is a page in our journal, our general journal. And first thing you will see is the date on the left side. And when we're looking at a general journal, we'll look at this further. When we look at general journals, we'll talk about this. The date is always, you'll see the day, the month, and the date will be on the first entry. Every entry after that will just have the date, the day, right? Just the second or the first or the third. After the first one, you don't have it until you either start a new month or you start a new page. Cash is a debit to the left. So when we're issuing, unlike a ledger, when we put things on one side or the other side, when we do a journal entry, the left side is always, the account to the left is our debit. That's going to be on the first line, and that will always be pushed all the way to the left. Debit account's name and dollar amount, and then we put the amount in the debit section on to our right, but it's going to be on the left side in the debit. And then in our accounts and explanation, we'll indent, because common stock is a credit account and goes to the right, we will indent our credit, and then that will push the credit over to the right, 30,000. And then we'll have a brief explanation, issue common stock. So date of the transaction, debit account name and dollar amount, and then credit account name and dollar amount. The credit account name is indented, right? So because it's a credit and it's to the right, it's going to be indented. So stockholder contribution. So once we have entered our journal entry, this is our journal entry, then we will move these over to our ledger. And so we have a $30,000 debit for cash. So we go to the cash account and we go to its account in the ledger and we put it on the left side, November 1st, $30,000. And then we have a credit of $30,000 of common stock. When we go to the common stock, we go to the right side and we put $30,000. So an asset, $30,000 cash, and then common stock, $30,000 credit, and that's going to go on the right. So left and right, common stock, and cash and common stock. Transaction number 2. So now we're going to, first thing we're going to figure out what we're going to do here. Purchase of land for cash. On November 2nd, Smart Touch Learning paid $20,000 cash for land. What accounts are going to be affected in this? So we have cash, right? We pay cash, and the other account is going to be land, right? So cash is going to go down. We spent $20,000, right? So that's going to decrease. Cash is an asset. It's going to be decreasing. It's going to be a credit. Land is an asset and it increased. So land is an asset and it's going to increase. Is going to be our debit. So our first account going to be shown is land. It's our debit. November 2nd, land, $20,000. And so I know it's putting the month and the day here, but I guess they're either showing it each transaction separately. But when we look at this in a full page, we'll see that you only put the date. Land to the left, debit, $20,000. Cash is indented to the right, credit, $20,000. And land is increasing, cash is decreasing. Then we have our explanation, cash, pay cash for land. We add this $20,000 to our cash account in the ledger, and that's going to go on the right because it is decreasing. And then land is increasing, and that's going to be on the left side is a debit, $20,000 land. And it has every time you put in a ledger entry, you date it. So you can go back and we'll see when we change, we'll talk about a different type of ledger. We'll see that we also do different things to mark the ledger to make sure we know where that transaction occurred. So transaction two, purchase of land for cash. We now look at our assets, right? So in this section, the first transaction, we had assets and equity, right? So we have equity going up and we have assets going up. So assets equals liability is equity. All of our assets are $30,000 cash, and we own all those assets, $30,000 of common stock. In our second transaction, we lowered cash by 20,000, but we increased land. So assets didn't change. The amount of assets didn't change. What assets consist of did change. Instead of having 30,000 all in cash, now we have $10,000 in cash and $20,000 in land. We didn't need to change equity or liabilities because nothing changed hands as far as that in. We didn't receive revenues. We didn't give out dividends. We didn't take on accounts payable or notes payable. None of those things happened. All we did was change what our assets consist of. Instead of having $30,000 in cash, we now have $20,000 in land and $10,000 in cash. Transaction number three, we purchase of office supplies on account. So here, what are we looking at? We're looking at office supplies, right? Smart Touch Learning buys $500 of office supplies on account November 3rd. So one account we're going to look at is office supplies. The other account is a liability, accounts payable. When it says we purchased it on account, we did not pay cash, right? That is accounts payable is not something we pay right now. This is something we're going to pay in the future. So we have office supplies is going to increase. That is an asset. It increases with the debit. So office supplies are debit. Accounts payable is on the right. It increases. Now, accounts payable is a liability. It increases. Now we owe $500. That goes up with a credit. And so that's going to be our credit. You indent the accounts payable, credits on the right, purchase of office supply on account. When we move these over to our ledger, we're going to move over the debit office supplies, increases our asset, and accounts payable decreases or increases our credit. It increases our liability with a credit. Sorry. Transaction four, on November 8th, Smart Touch Learning collected cash of $5,500 for service revenue that business earned by providing e-learning services for client. So here we provided a service and we collected cash. So there's no accounts receivable, it's cash. So what happened? November 8th, we have cash goes up. That is a debit, right? We received $5,500 in cash. And then we had service revenue goes up by credit. Revenue went up and cash went up. And our explanation is perform services and receive cash. So service revenue went up. That was a credit. Cash is an asset. It goes up by debit. Now we go and we put those into our ledger. Now we can see that we have November 8th, cash debit, $5,500, service revenue, a credit of $5,500. Both accounts went up. On November 10th, Smart Touch Learning performed services for clients for which the client will pay the company later. So this is still an asset, but it's not going to be cash. We're looking at the business earned $3,000 of service revenue on account. What are we looking at here? So we did perform the service, so we did get service revenue, but we did not receive the payment. So they're going to pay the company later. We have an accounts receivable. We're going to receive that payment later. That is still an asset. So instead of cash, In place of cash, we're going to have an asset of accounts receivable, and that is going to be a debit. That's an increase in accounts receivable of $3,000. And then revenue on the account, that goes up. That is a credit of $3,000. So service revenue, 3,000, accounts receivable, 3,000. Perform service on account, accounts receivable, we're going to bring that up as a debit. This is an asset. It's gone up $3,000. Service revenue is going up $3,000. Revenue goes up on November, and that's going to be a credit. See, double entry. We have our debit and we have our credit. Transaction number 6, payment of expenses with cash. Smart Touch Learning paid the following cash expenses on November 15th. We had to pay office rent of $2,000 and employee salary of $1,200. Here we have 3 accounts we're going to be looking at. One is office rent, that is an expense. The other is employee salary, that is an expense as well. But both of those are being paid with cash. So we have 3 different accounts. So office rent is an expense. Rent expense is going to go up. That goes up through debit. So that's going to be $2,000 debit. Salary is an expense. That goes up because we're increasing what we're paying in salary. Our expenses, salary expense is $1,200. That is our debit. We're going to indent. And we have our cash is going down. That's going to be our credit. We totaled both of these is $3,200. So we have $2,000, $1,200 debit, $3,200 credit. Paid cash expenses. Here we have 3 different accounts being done with one transaction, but they all even out. This is a compound journal entry, a journal entry with multiple debits or credits. Even though we had multiple debits in this account, in this transaction, we still were able to balance it out, and it still was a journal entry. So don't let multiple accounts scare you. You just got to make sure that they balance out. Payment of expenses with cash, then we move those accounts to our ledger. So now cash went down $3,200. That is our debit, our credit. And then our debit rent expense went up $2,000, and our salary expense went up $1,200. The overall effect of an increase in expense account is a decrease to equity. So even though expenses go up, when we have revenues, we're going to take that minus sign. This way we don't get a double negative. We just leave the expenses positive, right? As they go up, we leave them positive because we take our revenues and then we minus our expenses. And expenses increase because the business has more expenses now than before. Now, transaction number 7, payment on account, accounts payable. So we had let's say we had an account that we owed somebody. Now we're going to pay on that account. On November 21st, Smart Touch Learning paid $300 on the account payable created in transaction number 3. So we had accounts payable before for $500. We're going to pay that account down to $200. So we're paying $300 on that account. And accounts payable is now going down. That is decreasing because we're decreasing the amount that we owe. So accounts payable is decreasing with the debit. So accounts payable is a debit, $300, decreasing the amount that we owe the customer. Cash is decreasing because that's what we're paying to decrease the account. That is going down, so that is a credit. So accounts payables are debit. It decreases. Cash is decreasing as a credit and paid on account. So then we transfer those over to our journals, and the cash is showing a decrease. Accounts payable is showing a decrease with the debit, and cash showing a decrease with the credit. Transaction number 8, collection on account, accounts receivable. On November 22nd, Smart Touch Learning collected $2,000 cash from the client and transaction 5. So remember, we did a service for a client earlier. They owed us for it. So now they're actually starting to give us the payment that they owed us for that account. So a cash is going up. We received the cash, right? So that's an asset, goes up. It's a debit. Accounts receivable is now going down. They now owe us less. So now we have to decrease accounts receivable. Accounts receivable is an asset account, so it decreases through credit. So cash increases through a debit, 2,000. Accounts receivable decreases through credit, 2,000. And then we move those over to our journal our ledger accounts, and you can see the debit for the cash as it's going up, and accounts receivable is now a credit for 2,000. This is showing us if we balance this account right now, we would see that right now that company owes us, or we have $1,000 in accounts receivable. Transaction number 9, payment of cash dividend. On November 25th, a payment of $5,000 cash was paid for dividends. So dividends are equity, and they go up through debit. So as we go up and we pay more dividends, we have to debit that account. So dividends went up by $5,000, so we debit dividends by 5,000. Cash is what we paid those dividends. Those are the two accounts in this transaction, and cash went down by credit. Cash went down by 5,000, and that's a credit. If you ever get lost and say, I don't understand, I don't know what dividends are. I don't know if they go up or they go down with a debit or credit. One of the easiest ways to track it back is always try to figure out what happens to cash in this area, or what account is replacing cash, and what is happening to that account. And then you can always find out the other side of the transaction by finding out. Say we didn't know that dividends was a debit account and it increases. We do know that cash is going down because we paid $5,000 cash. So we know cash is going down through a credit. The other side of the transaction must be a debit. So it's always try to trace it back to cash, and you can always figure out your way on what's happening in the transaction. Transaction number 10, prepaid expenses. On December 1st, Smart Touch Learning prepays 3 months office rent of $3,000, right? So this is an asset, and it's going up. So now we have prepaid rent of $3,000 is going up. That is a debit. Cash is going down because we paid that cash. And so cash is a credit, decreases by credit. It's going down. So that is our credit. So we have prepaid rent, our debit, cash, our credit. And so we trace those down. Cash decreases. We have a debit account. Prepaid rent increases. We have an asset, right? So it's increasing 3,000 prepaid rent, and that is a debit. Transaction number 11, payment of expenses with cash. On December 1st, Smart Touch Learning paid employee salaries of $1,200. So now we have to pay out our salaries. We have a salary expense. Expenses go up through debit. So that is our debit. And cash went down. We paid it with cash. Cash goes down through credit. So cash is our credit. So we go down. We post our salary expense, $1,200 debit, and cash, $1,200 credit, as that is going down. Transaction 12, purchase a building with notes payable. So we purchased this building. Remember, notes payable usually is a longer period of time. So we purchased this building of $60,000. Probably going to be over a long period of time we're going to pay for this building. So we have a notes payable, not an accounts payable. Usually when you have something like this, is going to be a notes payable. Some kind of loan or something for a long period of time is going to be a notes payable. On December 1st, Smart Touch Learning purchased a $60,000 bill in exchange for a note payable. What accounts are we looking at here? We're looking at notes payable, right? We didn't pay it cash, right? And we're looking at a building. So building going up is an asset. That's going to be a debit. And notes payable going up is a liability that is increasing through a credit. So building is our debit. Notes payable is our credit, $60,000. Then we transfer those over to our ledger accounts. Building debit, notes payable credit. And transaction 13, stockholder contribution. On December 2nd, Smart Touch Learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bright. In exchange, Smart Touch Learning issued common stock. So here we have furniture, which is an asset going up. The company is receiving this furniture. It's an asset, $18,000 in furniture. So assets are going up. That's our debit. Common stock is what's going up. It's being received by the person who gave the furniture. That's going up. So common stock goes up through credit. And so we have our debit and our credit. Post our explanation, receive furniture in exchange for common stock. Then we move that to the ledger accounts. Furniture only has one entry, 18,000. Common stock now has two entries, right? So we have now $38,000 with the common stock as it increases by $18,000. On December 15th, Smart Touch Learning received a telephone bill for $100 and will pay the expense next month. This is an accounts payable, okay? It's not anything that we had to write out a loan for or a note for. This is something we're going to pay in the future. We just are not going to pay it right now. So we have two accounts here. First is expense, right? We have a telephone expense or utilities expense, and the other is a utilities payable, right? It's not cash because we haven't paid it yet. So utilities expense go up through debit. That's $100. Utilities payable is a credit. That's $100. So there's our debit and our credit. Move down to our ledger. Utilities payable gets a credit. Utilities expense gets a debit. Now, on transaction 15, payment of expense with cash. On December 15th, Smart Touch Learning paid employee salary of $1,200. Another payment, right? Salary expense going to be our debit. Cash went down, right? So we have these two accounts, salary expense and cash, right? We paid employees, that salary expense goes up. It increases by $1,200. That is a debit. Cash goes down. It decreases with a credit, $1,200 paid salaries. On December 21st, a law firm engages Smart Touch Learning to provide an e-learning service and agrees to pay $600 in advance, right? And so they're going to go ahead and book e-learning, right? But they want to go ahead and pay them in advance. So they're paying them $600. This is not revenue because e-learning has not earned this revenue. So this is an unearned revenue. This is not a asset. This is a liability. The asset in this transaction is cash. We did receive cash, so that goes up. Cash is our debit. Assets going up, debit. Unearned revenue is a liability. That is going up because we have to, if we don't perform this job, then we have to pay back that money. So we're liable for these funds until we perform the service. So unearned revenue is a liability. That is going up by $600. That is a credit. And so we can see cash going up through a debit, unearned revenue going up through a credit. And then on this transaction 17, earning of service revenue for cash. On December 28th, Smart Touch Learning collected cash of $8,000 for service revenue that the business earned by providing e-learning services for clients. Now, here we're looking at, unlike the last transaction, we did perform the service, right? And we did collect the cash. So here we have service revenue and we have cash. Cash is going up by $8,000. That is an asset. That's going to be our debit. Service revenue goes up through credit. We've already earned it. So we have service revenue of 8,000 credit. We then move those down to our ledger, and you can see all of our ledger accounts for cash, and then all of our revenue. Now we have another revenue account of $8,000 credit increasing. Ledger accounts after posting. So Exhibit F 2 through 7 on the following slide show Smart Touch Learning accounts after posting journal entries through or in November and December. Notice total assets is 114,700 equals total liabilities 60,900 plus equity 53,800. So what we did was we broke up the ledger accounts into their respected areas. So we have assets, all the different assets that we have and their ledger accounts, liabilities, all the liabilities and their respective ledger accounts, and then the 4 subdivided sections of equity and all their ledger accounts as well. So you can see. Now, all of these are already starting accounts receivable all the way to land. You can see they have a balance of a debit balance showing, right? So the accounts receivable did get a credit transaction. The cash is where you're going to have to mostly do your balancing. So how do you balance? With cash, we would add up all of our debits and then add up all of our credits. Take our total of debits minus our credits. Hopefully, we have more debits than credits, and then we put our balance at the bottom. And then accounts payable, whichever is larger. So our credit is larger. We take out our our credits minus our debits. Since the credits were larger, we get a balance, credit balance, and then we can add those up. So T accounts versus 4 column accounts. T accounts, we have our debits and our credits, our left and our right. We just add up all of our debits and then add up all of our credits. And we take the larger number minus the smaller number and bring down the balance. When it comes to a 4 column account or 4 column account ledger, every time we do a transaction, so you can see here on November 1st, we do a transaction, November 2nd, we do a transaction. Every time a transaction is entered, we have a posting reference. One of the differences you'll see is you'll have a debit and credit, just like the T accounts, but each transaction gets its own line, right? And every time we put in a transaction, we always balance the account. So on November 1st, we had a $30,000 debit. We have a $30,000 debit balance. November 2nd, we had a $20,000 credit. We rebalance the account and we see that we have a $10,000 debit balance. So the great thing about a 4 column account ledger is that every transaction we are updating the balance. So we can see the balance anytime that we look at the ledger, we can always refer to where it's at and see how the balance has changed. Posting reference. That is something else in the 4 column, right? When we post in the journal entries, every time we take in the journal entry in the general journal and we post it to the ledger, 4 column ledger, we reference where we got that entry, right? So as you can see, when we post cash to the ledger, we're posting reference is the ledger account 101. And when we post common stock to the ledger, our ledger account is 301. When we post to when we post to the ledger from the journal, we can see that we have journal page 1. So if I ever want to go back and say, "Hey, where did this ledger entry come from?" I can look at the posting reference and then reference the general journal and see how we and reference the general journal and see where that transaction occurred and vice versa. Okay, so that's it for section 2.3. And the next section, we're going to look at and prepare an unadjusted trial balance and illustrate how to use the trial balance to prepare financial statements. We'll see you in the next section. Let's go ahead and start section 2.4. We're getting closer to the end of this chapter. Hopefully, you've started to learn how to look at journal transactions, journal entries, and ledger entries as well, postings. So now we're going to take that information. We're going to move on to the trial balance. Now, a trial balance is a list of all ledger accounts with their balances at a point in time. So we're looking at usually at a point in time, we're looking at the end of the month, usually it's end of the month, end of the year kind of time period, end of the quarter. The asset accounts are listed first, followed by liabilities and then equity. We're listing it almost like a balance sheet. Okay. So, like a balance sheet, our assets are on one side, our our liabilities and equity are on the other side, and we just go in that order, right? And we also try to list them in the order of numbers, right? So to be more, when you start doing this and looking at it through the account numbers, you'll list them in the account number that helps them keep them more in order. Here, and one of the things I want to point out when we're looking at this trial balance, we do have debit and credit balances, right? We can see there is a debit balance, there's a credit balance on each shown on the statement. Uh, Usually financial statements don't show debit or credit balances. Usually when it's totals all the way to the right and subtotals when you indent. But this is the one balance sheet, or this is the one kind of statement that we're going to be looking at that does show debit and credit balances. The one when we look at it, the reason we want to do this, let me go ahead and look at it real quick. And the reason we want to do this, we want to make sure that our debit and our credit balances match up. We take this information. If they do, we can say, okay, every entry, the reason we do this is every entry had a debit, every entry had a credit, and the amounts evened out. Okay. This is the reason we want to put up a trial balances. If we did, this is to help us find any errors, like say we put in the wrong amount for one account and we omitted one account. We started off, I've had this happen when I was in the industry. You're sitting there, you're putting in transactions, you're listening to the journal, and you can even do this on I don't know if you can do it anymore on the electronic software that we have now. But back in the day when you were just using QuickBooks, it didn't have you make sure that the transaction was, or the entry was always balanced. It would just let you put in half an entry if you did it. So usually I would start putting in a journal entry, somebody walk in the office, start talking to me, I forget about it. I post it and I move on to the next entry. And here I only have a debit and I didn't put in my credit. So this having a trial balance will tell me if something's off. Now, we can look at our financial statements, income statement of retained earnings, and then our balance sheet. So if we look at our income statement, this tells us our net income, which we move over to our retained earnings. And then from retained earnings, that moves us over to our statement of retained earnings. It moves us over to our retained earnings, which falls under stockholders' equity, which falls in our balance sheet. Now, correcting the total trial balance errors. So you will have some errors especially if you're doing it first time using. Rarely do people get everything perfect the first time. It's okay. You're going to have errors. It's just making sure that you correct those errors and how to, find what was inputted incorrectly. If total debits do not equal total credits, search the trial balance for a missing account. You might not have put in an account on the trial balance, right? That's one of the things. Divide the difference between total debits and total credits by 2. This helps locate a missing debit or credit, right? Divide out the balance amount by 9. This helps locate a slide or transposition error. You divide by 9. By the meaning of slide is say that the entry is 131 or 1678, right? And a transposition would be 687, right? You just transposed, you move two of them around. By sliding, say you have 1,000 and 100, by sliding, you've put in an entry that's 1,000, and really the entry was 100. And on one of them you put 100, and one of them you put 1,000, and that will be a slide. You're just sliding over the decimal place. Even if total debits equals total credits, there can still be errors such as the use of the wrong accounts. You can have use of the wrong accounts, or you could have omitted an entry totally, right? That happens as well. This only tells you if you've only gotten one side of the entry wrong. Okay. So that's where you can still have errors. We're going to go ahead and continue with 2.5 since this is such a small section. And we're going to describe the accounting cycle. So what happens in the accounting cycle? First, we start with the beginning of the account balance. Okay. So every accounting cycle, we start with what we have, the account balances. We analyze and journalize transactions in the journal, right? And we go and we look at the new transactions that happened during the cycle. We post them. We journalize those transactions. Then we post those entries to the accounts in the ledger, and then we prepare the adjusted trial balance. So this is the accounting cycle. We start off with the beginning account balances where we left off in the last month or the last quarter, and we go ahead and start doing and enter new journal entries for our new transactions, and then we post those entries to our ledger. And then from our ledger, we create a trial balance. And we're going to go ahead and finish up the chapter with 2.6. Use the debt ratio to evaluate business performance. So, how do you use debt ratio to evaluate business performance? So, what is the debt ratio, right? So, the debt ratio first is total liabilities over total assets. What we're looking at is how much do we owe out of all of our assets. You don't want to have a company that has too much debt, right? You want it to be a healthy company. It can evaluate business's ability to pay its debt and determine if the company has too much debt to be considered financially healthy. You don't want to take on a company that has too much debt and that it may not be able to pay its bills. Usually, when companies aren't doing well, they end up taking on a lot of debt, and that debt ends up sending them on a downward spiral. They can't make their bills. And if they're using credit to make their daily purchases and to cover the daily expenses, this is not a good sign that the company is healthy, that it's actually on a downward spiral. And unless it makes some major changes, it usually will not survive. So the debt ratio can tell us how much debt do we have compared to what we have in total assets. And if that is high, then we won't consider that company. Maybe low, if you look at the finance side of this, low is good, right? But not too low. That means they're not utilizing enough debt to go ahead and expand out the company. PepsiCo's balance sheet for the year ending on December 25th, 2021 reported in millions. Total liability 76,226 million and total assets 92,377 million. The debt ratio for Pepsi Company as of December 25th, 2021 is as follows: 82.6%. So of its total assets, 82% is total liabilities. Now, that's pretty high, right? Total liabilities and total assets. So we have an 82%. But we also have to look at that industry. Does this industry use a lot of debt, right? Some industries don't use a lot of debt at all. Some industries use a lot of debt to have things flow correctly. And to know if this is really a good number, we would need maybe to go and get Coke's balance sheet, look at what their debt to debt ratio is, and if it's in the same balance, or if it's lower, right? Or if it's very low. And that tells us which is a safer company. We can also look at it and say maybe Pepsi's in a little bit of trouble. But for the most part, Pepsi's always been a pretty safe company. We don't see them going. They have plenty of assets, and probably we would look at cash also to see if they could cover that. They have assets to cover this, and we would need to see how much of those assets are cash or how much of those are liquid and able to pay their total liabilities. So this is something just to look into. If you are going to analyze a company, debt ratio can tell you a lot. It can't tell you everything, and it can't tell you specifically if it's good or bad unless you look at the total, like, you look at a equivalent industry or equivalent competitor to see if it's right or okay, hopefully this helps you out a little bit. It helps you understand the chapter a lot better. If you have any questions or concerns, or if you want to talk more in depth on any of these issues, or any of these subjects, any section of this chapter, please reach out. I'd be more than happy to discuss it with you and help explain it further.